debt management refers to the process of planning, organizing, and controlling the amount of debt taken by individual. The main objective is to ensure that debts are repaid on time without causing financial stress or leading to insolvency. It involves strategy to borrow, repair, and manage debt responsibly, which is essential to maintaining financial sustainability and economic stability. In today's increasingly complex financial environment, however, effective debt management has become more challenging due to various factors such as inflation, uncertain income, and higher living costs. To manage debt effectively, there are three key methods that can be applied. First, budgeting and financial planning, which helps individuals keep track of incomes and expenses while setting clear financial goals. Second, debt consolidations, which combines multiple debt into a single loans with a lower interest rate to ease repayment. Third, monitoring and evaluation, which involves regularly reviewing one's financial status and making adjustments where necessary. By applying this method, individuals and organizations can avoid financial crisis and maintain a stable financial footing.
As you can see on the left-hand side, we have identified 4 critical objectives that will guide our financial decisions and actions. First is to ensure the timely repayment of debt. This isn't just about meeting deadlines, it's about maintaining our financial integrity, building trust with lenders, and avoiding costly penalties. A strong track record of timely repayment is fundamental for our long-term financial health. Secondly, we aim to avoid over-indebtedness. While debt can be a valuable tool for growth, excessive borrowing can lead to significant financial strain and limit our flexibility. Our strategy focuses on prudent debt management, ensuring that our debt levels remain sustainable and aligned with our capacity to generate revenue. Our third objective is to minimize the cost of borrowing. Every dollar saved on interest payments is a dollar that can be reinvested into our operations or returned to stakeholders. This involves actively seeking competitive rates, managing our credit profile, and exploring various financing options to secure the most favorable terms possible. Finally, and critically, we strive to strengthen financial stability. This encompasses a broad range of measures, including maintaining healthy liquidity, diversifying our revenue streams, and building robust contingency plans. A strong and stable financial foundation is essential to weather economic fluctuations and pursue strategic opportunities with confidence. Achieving our objective will naturally lead to a series of positive outcomes, which are listed on the right-hand side. The most immediate outcome is improved financial stability. By meticulously managing our debt, avoiding over-leveraging, and strengthening our financial base, we anticipate a significantly more resilient financial position. This means less vulnerability to market shocks and greater confidence in our ability to meet future obligations. Secondly, we expect to achieve better credit ratings. Timely debt repayment and a conservative approach to borrowing directly contribute to a strong credit profile. Improved credit ratings translate into lower borrowing costs in the future, making it easier and cheaper for us to access capital when needed. A vital outcome is the avoidance of insolvency or bankruptcy. This is, of course, the ultimate goal of sound financial management. By proactively addressing debt, maintaining stability, and ensuring our financial health, we significantly mitigate the risk of financial distress and ensure the long-term viability of our operations. And lastly, achieving these outcomes provides strong support for long-term growth. When we are financially stable, we have access to affordable capital, and are not burdened by excessive debt, we are in much stronger position to invest in expansion, innovation, and strategic initiatives that drive sustainable growth for the future.
Talk about the first issue, buy now pay later or BNPL. It's a payment method that exploded in popularity, letting us get what we want now and pay it for later. But what does this trend really mean for us? First, let's look at the numbers, especially here in Malaysia. BNPL usage has absolutely soared from the first quarter of 2023, where 3.7 million active BNPL accounts. We have witnessed a massive jump to a staggering 5.1 million active accounts by the second half of 2024. That's millions of people embracing this payment method, showing just how widespread it's become. This rapid growth also brings a significant concern, BNPL addiction. We are seeing a worrying trend, particularly among young people, getting trapped in debt because of it. So why are so many of us falling into this cycle? It often comes down to a few key factors. First is delayed payments. With payment plans stretching up to 12 months, it's incredibly easy to lose track and forget about upcoming installment. Second, too easy to access. The NPL is designed for instant gratification, just few taps, minimal approvals, and your purchase is made. And the third one is present bias. We are wired prioritize immediate rewards. The NPL taps into this by letting us feel good now, often pushing the financial consequences to the back of our mind. And the last one is spending on wants, not needs. The NPL frequently fuels purchases of non-essential items like latest skincare, trendy clothes, or new gadgets. It makes those wants feel instantly attainable. So how can we navigate this trend responsibly? It's about being proactive. First one is set personal limits. Decide what you truly need versus what you want and stick to a budget. The second one is seek for financial advice. If you find yourself struggling, don't hesitate to reach out to a financial advisor who can really help you. And the last one is track your spending. Actively monitor every single BNPL payment using apps or a simple notebook. To conclude, BNPL can be a useful tool, but only if we are in control.
Next, we move to the second issue, which is car loan. At the top of the slide, you can see a bar chart illustrating the average outstanding car loan balance per person by states 2020 to 2022 in ringgit Malaysia. This data provides a crucial snapshot of consumer debt related to vehicles across different states in Malaysia over a 3-year period. Looking at the graph, we can observe the average outstanding balances across various states. It's important to note the differences and perhaps identify regions where car loan debt is particularly high or low. The 3-year trend allows us to see if there's been general increase, decrease, or stability in average outstanding balance during this period. This data is vital because a high average outstanding balance can indicate various things. Perhaps more expensive vehicles are being purchased. Now, let's explore some of the underlying reasons why this matter happened, why individuals might find themselves with high or challenging car loan balances. On the bottom right, we have identified key factors contributing to these outstanding balances and potential issues. Lack of financial planning. Often, individuals jump into car ownership without a comprehensive financial plan. This can lead to choosing a car that's beyond their budget, not considering the full cost of ownership, or failing to account for future financial changes. High interest rates. Car loans can come with varying interest rates. If an individual isn't careful or doesn't have a strong credit profile, they might end up with a high interest rate, significantly increasing the total cost of the car over the loan term. Depreciation of car value. Unlike the real estate, cars are depreciating assets. The moment you drive a new car off the lot, its value drops. This means that for a significant portion of the loan, you might owe more on the car than it's actually worth. Over-ambitious car purchase. This relates back to financial planning. People often purchase cars that are too expensive for their income or lifestyle. Driven by aspiration rather than affordability, this leads to higher monthly payments and a larger overall debt burden. Next, let's look at the practical solutions to mitigate these issues and manage car loans more effectively. On the bottom left, we have proposed several actionable solutions. Compare interest rates before taking a car loan. This is crucial. Don't just accept the first offer. Shop around different banks and financial institutions to secure the most competitive interest rate. Choose a shorter loan term. While a longer loan term means lower monthly payments, it also means paying more in total interest over time. Opting for the shortest loan term you can comfortably afford will save you significant money in the long run. Prioritize paying down high interest debts first. If you have multiple debts, focus on paying off those with the highest interest rates first. This strategy often called the debt avalanche method. Maintain on-time payments. This cannot be stressed enough. Consistent on-time payments are vital for maintaining a good credit score. A good credit score can lead to better interest rates on future loans and reflect financial discipline. Missing payments incurs penalties and damages your creditworthiness. Review payment options. Some loans offer flexible payment options, such as making weekly payments instead of monthly, which can sometimes reduce the total interest paid by adding an extra payment over a year. Understanding the factors that contribute to outstanding balances and implementing strategic solutions can empower individuals to manage this debt wisely and maintain their financial health.
Next, I'll continue with the next issue in debt management, which is credit card loan. According to the CTOS Statement of Consumer Credit in Malaysia 2022, credit card utilization among Malaysians has increased to 23.7%, showing that more people are relying on credit cards for daily expenses. On average, a person owns 2.17 credit cards, and the average outstanding balance per person is RM 11,955, which is actually the lowest ever recorded. This means that while more people are using credit cards, they may be becoming more disciplined and repaying what they owe. However, this increasing usage still raises concerns about long-term financial health, especially if not managed carefully. There are several reasons why people continue to depend on credit cards. Firstly, credit cards offer convenience and easy access to credit, which can lead to overspending. Additionally, a lack of financial literacy contributes to poor credit card usage and repayment behavior. Other contributing factors include emergency or unplanned expenses, and the rising cost of living combined with slow income growth. These pressures push individuals to use credit cards as a short-term solutions, which can eventually lead to long-term debt problem if not managed carefully. To tackle these issues, it's important to understand how to use credit cards wisely. Individuals should take simple steps to maintain their financial control. This includes paying the full balance on time, using less than 30% of the credit limit, setting up auto payment, and monitoring spending regularly. Credit cards should also be used with a set monthly budget to avoid overspending. By doing so, users can avoid interest charge, maintain a healthy credit score, and use the card's benefits such as reward points and emergency credit lines without falling into debt. Responsible usage is especially important because once debt accumulates, the interest can grow rapidly and affect a person's overall financial stability.
Now we are going to the next issue, which is education loan. As we can see on this slide, we can see a graph that shows how many people have taken PTPTN loans and how many have actually started paying them back. Based on the data, around 44% of borrowers have not begun repayment yet. So, why is this happening? The first one is rising cost of higher education. Over the years, studying has become more expensive. This high cost push students to borrow more, and the more they borrow, the harder it is to repay later. The second one is low starting salary. After graduation, many students do not get a high-paying jobs right away. So, they tend to postpone their loan repayment because they feel they just cannot afford it yet, even though the repayment may only 100 to 150 ringgit a month. The third one is poor financial awareness. Some students take out loans without really understanding what that means. Without this knowledge, it's easy to make mistakes like ignoring emails or thinking they will pay it later, which only worsens the situation. And the last one is delay repayment culture. There is also a habit among borrowers to delay payment. So, end up, they paying more in the end, and the debt feels heavier than it actually is. So, what can people do to improve this? There is several solutions that people can do. The first one is cut unnecessary spending. Start by looking at where your money goes each month. Even saving 50 to 100 ringgit per month can help cover your loan payments. The second one is understand the loan terms. Before or after taking the loan, make sure to really understand the agreement. This gives you control and helps you to avoid surprises like late fees or sudden increases. Next is set up auto debit or salary deduction. Auto debit means your loan payment is automatically deducted from your bank account every month. This is the easiest way to stay consistent and avoid mispayment. And the last one is start paying early. Even if the loan only requires you to pay after graduation, it's a good idea to start small payments yearly, even 20 to 50 ringgit per month, because it can reduce your total debt, prevents interest from piling up, and builds good repayment habits.
Last but not least, we will discuss about housing loan. As shown in the chart, residential property loans make up the largest portion of total household debt in the country. Why is this a concern? So let me explain three main issues from housing loan. Firstly, a large financial commitment. A housing loan is usually the biggest financial commitment an individual will take in their lifetime. In Malaysia, home prices often range from 300,000 ringgit to over 1 million ringgit, and most buyers cannot afford to pay upfront. As a result, they take long-term loans with monthly repayments spanning up to 35 years. This creates a major strain on their finances because a large portion of monthly income is used to repay the loan, and it reduces financial flexibility as they are left with less money for savings or emergencies. The second issue is long-term interest burden. Housing loans come with a long-term interest burden that many borrowers underestimate. Although monthly repayments may seem manageable, interest compounds over time, especially with long tenures. If borrowers don't make early repayments or fail to choose the right loan structure, they may end up paying far more than necessary. This increases overall debt pressure and limits their ability to plan for other goals such as retirement or children's education. The third issue is risk of default and foreclosure. The most serious debt management issue tied to housing loans is the risk of default, which is failing to pay monthly installments. If a borrower misses payments for a few consecutive months, the bank has the legal right to declare the loan in default, repossess the property, and also auction off the house. This situation not only leads to the loss of one's home but also causes a bad credit record, which affects the ability to get future loans, potential legal action, and also emotional and psychological stress for the entire household. For the solutions, borrowers must be disciplined in how much they borrow. Experts recommend keeping your debt service ratio below 40 to 50% of your monthly income. This ensures that borrowers are not stretching their finances too thin. Borrowers should also create a realistic monthly budget that includes their loan payments, daily expenses, and savings. Other than that, to reduce interest burden, borrowers should choose a flexible or semi-flexible housing loan. This allows you to make extra payments anytime, which directly lowers the principals and your total interest. For example, putting your annual bonus or tax refund towards your loan helps you finish it faster and save money. Lastly, to prevent the risk of default or foreclosure, it is crucial to have an emergency saving funds with at least 3 to 6 months of living expenses. This protects borrowers in case of job loss or unexpected financial problems. Borrowers may set up automatic payments so you never miss a due date. And if you ever feel you're falling behind, reach out to your banks or AQPK early.
Firstly, and perhaps most importantly, we have gained a deeper appreciation for the importance of managing debt wisely. This isn't just a theoretical concept, it's a practical necessity. We have seen how strategic debt utilization can fuel growth, but also how imprudent borrowing can lead to significant distress. This reflection reinforces the need for meticulous planning and careful consideration before incurring any financial obligations. Secondly, we now profoundly understand how debt impacts both individuals and countries. Moving beyond the micro level, our research and analysis have highlighted the ripple effects of debt, from personal financial struggles to national economic stability. This broadened perspective underscores the interconnectedness of financial decisions at all levels, emphasizing the societal implications of debt management. And finally, this assignment has made us much more aware of the critical need for financial literacy. In today's complex economic landscape, having a solid understanding of financial principle, risk, and opportunities is no longer a luxury but a fundamental requirement. This awareness fuels our commitment to continuous learning and advocating for greater financial education. These reflections naturally lead us to the core lessons learned that we believe are essential for anyone navigating the financial world. Based on our experience and the insight gained, these are the 3 paramount lessons we had like to share. The first crucial lesson is to borrow only when necessary. This might sound simple, but it's often overlooked. Debt should be a tool for strategic investment or essential needs, not a casual solution for immediate gratification. Adopting a disciplined approach to borrowing minimizes risk and maintains financial flexibility. Secondly, we learn the transparency builds trust, whether it's within a team managing a project's finances, between a company and its stakeholders, or even within personal financial dealings. Openness about financial positions, challenges, and decisions foster confidence and strengthens relationships. Hiding or obscuring financial realities only leads to mistrust and compounded problems. And perhaps the most overarching lesson is that planning is crucial. From setting clear objectives and budgeting to forecasting and risk mitigation, meticulous financial planning is the bedrock of success. Without a well-thought-out plan, financial decisions can become reactive, leading to inefficiencies and missed opportunities. Planning provides foresight, control, and a clear path forward. These reflections and lessons learned have not only enhanced our understanding of finance but have also equipped us with practical wisdom that we will carry forward.
Now, I will share about future improvement. First, it is important to learn about the loans before borrowing. Make sure to understand the interest, how long it will take to pay it back, and if we can afford it or not. This can help us to avoid taking a loan that might be too hard to pay it back. Other than that, we can try to create a monthly budget. Write down our income and expenses every month so we know how much money we can use to pay off debt. This can help us to avoid spending too much and missing payments. We also should avoid taking new debt unless we really need it. We should only borrow money when it is really important and not for things we just want. This can help to keep our debt from growing too much. And the last one is try to start an emergency fund. Even saving small amount every month like 50 ringgit can help us during emergencies. Having this fund can allow us to handle urgent situations without needing to taking a loans or credit cards. By following these steps, people can manage their money better and stay out of debt.
We're moving on to the next slide, which is our project timeline. Our group project began in April, where we received the assignment guidelines from Dr. Akila. We started by reading and understanding the instruction carefully, followed by a group discussion to decide on the topic. During the same month, we attend the My Money and Me seminar, which helped us understand the context of the project better. After the seminar, we divide the tasks among group members and began selecting relevant issues or challenges related to the topic. We also start conducting research to gather useful content. In May, we continue working on the project by collecting all our findings and organizing them into a slide presentation. We then finalize the report and proceed to create a video presentation based on our content. Finally, in June, we submit both the infographic report and video presentation to Dr. Akila. This timeline helps us manage our tasks efficiently and complete the project in structured and timely manner.